And now, this session's featured speakers are Bentley University professors David Gulley and Laura Jackson-Young, also alumna from the class of 2010, and Nick Fahmie, class of 2012, who is Vice President of Equity Research at Goldman Sachs. David Gulley is the chair of the Department of Economics and has been at Bentley since 1990. He specializes in macroeconomics, monetary economics, and financial markets. He has been co-advisor to Bentley's Fed Challenge teams since 2007 and teaches courses in macroeconomics and monetary economics at both the undergraduate and graduate levels. He is also a proud alum of the University of Kentucky. Laura earned her PhD in economics from the University of North Carolina and joined the Bentley faculty as an assistant professor in 2015. Her research and teaching interests focus on macroeconomics, business cycles, and monetary policy. This year, she joined Dave as co-advisor to the Bentley Fed Challenge team. She competed on the team as a Bentley student in 2009 and is a proud 2010 grad, as I mentioned. After graduating from Bentley in 2012, Nick started his career at Barclays on the equity derivatives trading desk. After 2 years, he moved into equity research at Barclays, covering large cap diversified industrials. He also is an alum of the Fed Challenge, class of 2011 Fed Challenge. And in 2017, Nick joined Goldman Sachs and is responsible for coverage on 19 stocks in the freight transportation industry. So without further ado, please join me in virtually welcoming Professors Gulley, Jackson-Young, and Nick Fahmie.
Thank you, Emily, for that very kind introduction. Let me share the screen here. Okay. All right, hi everybody. Thank you so much for attending today. So we're looking at the economic impact of the COVID-19 crisis and the response of policymakers. I'm Dave Gulley. Of course, we're joined by Nick and Laura. And so I'll start us off. Laura will be next, and then Nick will act as closer. So our agenda today, we're going to look at the current state of the economy, the monetary and fiscal policy response, and then where we go from here. Our general summary is that things are not very good overall, but we have seen some dramatic improvement here in recent months. The monetary and the fiscal policy response have both been both large and exceptionally aggressive, and they have both made a material difference. And in terms of where we go from here, a lot of it depends on, as Jerome Powell and others have said, the evolution of the COVID-19 virus. So to take kind of a snapshot of where we are in the economy, March and April were by far the worst months. The decline in first quarter GDP was pretty impressive, and then we had just an outright collapse in the second quarter. We have seen large improvements in almost all data since May. For example, unemployment has been declining, employment has been rising, but there are still a number of problems. For example, jobless claims on a weekly basis are still exceptionally elevated. And we've also seen very, very disparate impacts across different sectors of the economies, as we'll document. And so in terms of the data, this is the real GDP figures going back to 2016. And so you can see 2016, 17, 18, and 19, we had normal 2-ish% at an annual rate GDP growth. And then in the first quarter of 2020, GDP fell at a 5% seasonally adjusted annual rate. Then in the second quarter, it absolutely collapsed at a 31.7% annual rate. And we have never seen a decline like that, even at the worst periods of the Great Depression in the 1930s. So this really is truly historic. Another angle on this is the unemployment rate. As late as February of this year, the unemployment rate was running around 3.5 or 3.6%. It skyrocketed up to well over 14% and has now declined, fortunately, down to a still elevated 8.4%. But even that might sort of make the state of the unemployment or state of the employment market a little bit more rosy than it really actually is. And so in terms of disparate impacts, some parts of the economy have done actually quite well in terms of the recovery. For example, as we'll see in a second, new home sales and the stock market. Other sectors, other parts of the economy have not bounced back nearly as well. Again, we have some good visuals on this. So after initially falling off during the very beginning of the pandemic, as people stayed home and the real estate industry more or less stopped, new home sales, especially in certain parts of the country, the suburbs, larger homes that are relatively isolated and so forth, those have skyrocketed. New home prices have also increased as inventory has declined. And so the housing sector, unlike the Great Recession in 2008 and 2009, is actually doing really quite well overall. If you're a participant in the stock market, things were looking terrible in March and April, but they have looked up, of course, dramatically since then. With the exception of the last couple of weeks, the stock market has seen a very strong recovery. And of course, what they're doing there is they're looking ahead, trying to anticipate the end of the current economic problems. But on the other hand, there are still material problems throughout the economy. For example, long-term unemployment is starting to rise very dramatically. You can see by the arrow there, and we expect that to skyrocket even further. At the beginning of the recession is now 6 months ago, so longer-term unemployment is now beginning to rise. And the difficulty there is, even as the economy recovers, the longer people are unemployed and out of work, the less likely it is that they're able to achieve reemployment even once the economy gets better. Looking at unemployment across different races and both genders, as you can see early in the pandemic, unemployment rates on all metrics have risen dramatically. They have all since fallen, but the differences between unemployment rates for whites, for Hispanics, and for Blacks have, from levels that we saw prior to the pandemic, again, beginning in March. In terms of impact on different levels of income, or people with different levels of income, Chetty and others have very recently published a very interesting paper, and they were able to track daily spending for higher and lower income quartiles. And so the top orange dotted line, that represents daily spending over the same time last year in 2019 for upper quartile income groups. The orange, solid orange line, however, that represents daily spending this year by the same income group. And as you can see, their spending has declined dramatically. It's picked up certainly from its worst, but it's still down. Down on the lower part of the chart, the two green lines, the dotted green line represents average weekly spending for the bottom income quartile, or average daily spending rather, and the solid green line is similar data for this year, 2020. And as you can see, from an initial decrease, spending has bounced back very nicely. And a lot of that is based on the stimulus checks and the additional unemployment benefits that Nick will be talking about here in just a few minutes. But in terms of the job losses, however, the decline in spending by the upper income quartiles have translated directly into material job losses for lower income quartiles. And so you can see in the top green line, that's the employment rates for the top quartile income levels. And after the initial decline, that has bounced back not quite to its initial level beginning, from the beginning of the pandemic. People in lower income quartiles, on the other hand, have not seen nearly the bounce back. It's certainly improved, but there's still a gigantic decline here. And the idea is fairly straightforward. People with higher incomes, they're not traveling anymore. They've reduced going out to restaurants, staying in hotels and other things. And so people who were employed in those industries have not seen yet their jobs bounce back, unfortunately. We're also very concerned about a number of long-term effects. One of the ones I mentioned just a few minutes ago is in terms of people not being able to find employment again, even once the economy recovers, because they've been out of work for a long time. We're also concerned about the effects on what economists call human capital, education, skill, experience, and things like this. And so Chetty, in this very same paper, they gathered data on an online learning platform for math lessons, and they were able to break down the lessons completed by different income quartiles. All income quartiles have seen lower completion of these lessons, but people with the lowest income quartiles have seen the largest declines. And to the extent that this is correlated with difficulties associated with accessing online learning platforms, of course, we've all heard stories about how kids in lower income or rural households have had difficulty accessing the internet. These potentially have long-term, years or even decades worth of impacts. And so let me close here, and we'll now turn it over to Laura.
Yes, thanks, Dave. So given the kind of dismal picture, I guess, that we can see when you're looking at observations in the data, we want to kind of take a look at, how did policymakers respond, and were their actions actually effective in terms of kind of helping to mitigate the economic consequences of the crisis. And so I'm going to argue and show some evidence that the policy actions do seem to have mattered quite a bit, at least in terms of providing the support so that the economic contraction wasn't any worse. And so it's not necessarily saying things are great, but it's kind of showing that policymakers did go a long way in terms of providing that support structure, and in particular, providing kind of a backstop to establish the foundation from which the economy can then start to recover once we start to see some activity back on behalf of households and businesses. And so we're going to take a look at two different lenses. And so first, thinking about monetary policy, the Federal Reserve, the Central Bank of the United States, really did kind of go a long way in terms of making sure that the financial market, financial system did still have the infrastructure and the liquidity in order to operate appropriately. And so the direct effect of the actions of monetary policymakers was to affect kind of the volume and cost of credit. So this is sort of the immediate impact of what they're doing. And so this allows, to efficiently see financial markets operating to kind of match borrowers and lenders, to make sure that banks are still making loans to those people that in the current environment most desperately need them. But the indirect effect then from, this immediate impact, the indirect effect really is much broader and has more important complications. In particular, if you look at supporting asset prices, so Dave looked a little bit at kind of the housing market, and we're seeing some support there, as well as if you look at the stock market, that really, sentiment regarding the stock market does drive a lot of household behavior. And so while the immediate impact, like I said, affects the economy today, given the nature of financial markets being forward-looking, and the way in which, businesses and households both try to plan their spending behavior, it's really sort of that expectation of where we're going in the future that's going to provide the incentive to act today. And so we'll see situations in which monetary policy makes a concerted effort to affect expectations about future policy, where inflation, where the price level is going, what it will cost to borrow in the future. And then we see sort of a circular effect where that's going to affect how households, if they're willing to go out and spend today, or if businesses are willing to expand. And so the central bank kind of approaches this problem with their goals of low and stable inflation, which they've had some evolution over time about what that actually means. And right now they're defining that as around 2% on average per year. But then also ensuring maximum sustainable employment, so getting people back to work in particular in today's environment. So what has the central bank in the United States, what has the Fed actually done? So first, their first line of attack is to use their traditional policy instrument of the federal funds rate. So this is our short-term borrowing rate. While it is between banks, if you remember back to your econ classes, this we know affects interest rates in all other financial markets. It's kind of like a benchmark idea. And so what they did was they lowered this back down to the zero lower bound. We did reach the zero lower bound in 2008. So during the financial crisis, we reached the zero lower bound and stayed there until 2015. Since the recovery had been quite robust following that time, we were starting to normalize and get a little bit away from zero. But in response here, the Fed dramatically cut the interest rate again, and then started to kind of incorporate some of the other tools that they did introduce also in the environment around the financial crisis. So they started to try to provide more liquidity to financial markets by buying treasuries and mortgage-backed securities. This is the policy that we know as quantitative easing. And then to incorporate really that forward-looking component, they're using a lot of very aggressive and careful communication to use some forward guidance where they're specifically trying to make it an influence on future expectations to then circle back and affect what's going on today. And then the last kind of pillar of their policy response is quite a bit complex, I think, compared to the other things that we're talking about here. And they introduced a variety of lending programs. And so, you know, the details of all of those in particular and specific details are a conversation for another day. But really their intention is to, you know, support financial markets and make sure that lending happens in order to get funds to those participants that need them most. So we're looking here, they kind of expanded to help support markets that would lend to small and medium businesses, to cities, municipalities, that kind of thing, to really make sure that these markets are operating efficiently. So if we take a look at some of the data, kind of just like visualize what the Fed actually did, their traditional policy instrument, that short-term lending rate, they dropped to the zero lower bound. And so you can see here that first gray bar, that's the financial crisis. So again, we saw this big dramatic decline. We lowered borrowing costs. We're really trying to stimulate spending. And then while we started recovering, you know, late 20-teens, we again dropped that down to zero. But if we want to compare these two times, and in particular compare this to previous recessions before, that traditional policy response may be a bit limited today. Given that we started really only, you know, around a little over 2%, we were able to drop the Fed funds rate about little over 2 percentage points to bring us back down to zero. Whereas in previous recession experiences, the Fed had a lot more room. So maybe, you know, upwards of 5-6 percentage points. And since we're not really experimenting with negative interest rates in the US, the zero lower bound is pretty much a binding constraint. So if we think kind of their traditional approach has been maybe a bit constrained in terms of how much accommodation they could provide for financial markets. But even still, they were able to achieve really quite an aggressive and really dramatic effect on providing this volume of liquidity to financial markets. So here, if you take a look at, you know, kind of the broader effect of lowering interest rates as we look at how the money supply is changing. And so if we look at growth in the money supply during the financial crisis, we did see this pretty substantial increase, or really aggressive pumping cash into the economy to try to kind of support these financial markets. The response during the current crisis was even much more dramatic, right? So this really heavy volume of liquidity provided to markets in order to really support that lending. But so kind of one, you know, concern is that as a result, when we're pumping all this cash into the economy, how does the Fed really do that? They need to purchase assets. And so they're starting to intervene in markets in which they're accumulating assets onto their balance sheet that in volume are much bigger than they had done in the past, as well as in composition. So if you hear the different colors are just different types of assets that the Fed is purchasing. And so you can see, one, the size of the balance sheet is much larger, and the types of assets that are on there are quite different. And so, you know, pre-financial crisis, the central bank's balance sheet was made up of mostly short-term treasuries, where now we've got treasuries across the maturity spectrum. We've got short, medium, long-term. They're, again, like I said, kind of intervening in these mortgage-backed security markets. So really starting to become a major player in financial markets that they hadn't been in the past. But in doing so, they're able to ease lending standards, to ease borrowing conditions, and really start to support the economic, you know, spending and momentum in the economy as a result. So given this very aggressive, very wide-ranging policy response, do we want to see kind of, did the Fed's response really do much? And it does seem that in, you know, material terms, we're getting some real economic consequences. Supporting the economy, the contraction maybe was less steep and less severe as could have been seen otherwise, but really there are limitations to what we can do with monetary policy. And so those standard tools, if you just look at something like interest rate policy or changes in the money supply, these are quite blunt and it's just applied to kind of the broader economy as a whole, right? We have one central bank for the entire United States. And so in order to kind of introduce something a little bit more targeted towards those industries or those markets that are struggling given the unique nature of the current crisis. These lending facilities are much more targeted, you know, trying to get cash to small and medium businesses or trying to make loans to municipalities. But there are some limitations there where, they're targeting specific groups and perhaps excluding others, or some of the standards and restrictions are quite complicated. So, some perhaps small businesses are excluded simply because they don't know how to navigate getting access to these credit markets. And then again, some other situations in which these policies may struggle a little bit is that, right, we have these tools that we're trying to influence liquidity, trying to influence our expectations about what's going on in the future. The Fed can insert liquidity into these markets, but really to see the economic effects, that needs to be translated into spending, and spending on behalf of households, on behalf of businesses, really kind of revving up economic momentum. Whereas if there are interventions in place, such as stay-at-home orders or limitations perhaps on the amount of people that can be in restaurants, for example, or a lot of wariness on behalf of consumers, people aren't super excited about going out and getting back to be an active member of their local community, the economic consequence, or the economic effects will be a little bit more limited. But so even though we have these limitations, and if you look in particular at some of those lending programs, maybe we don't see a ton of activity there, that doesn't necessarily mean that these policies were not effective and did not have their intended, consequence. So one data point I just want to show before I finish is looking at the cost of borrowing for corporations. And so if you look at some of those lending programs targeted towards small and medium businesses, for example, the take-up, the number of people trying to get access to those loans are quite low, but the cost of borrowing has fallen dramatically. And so simply the Fed announcing we're going to introduce a tool to support credit markets for these individuals or for these corporations, the cost of borrowing fell because there was really kind of a vote of confidence that the central bank was there to support that market. So it's having the intended effect, even though maybe on the surface it doesn't look like we have the type of volume and activity that would be expected. So I'm going to let Nick take the fiscal policy response.
Yeah, absolutely. Thanks, Laura. So, I think one thing, that Laura touched on quite a bit was, monetary policy and the ways that can, impact markets overall. But one of the biggest ways that they impact it is through businesses, right? So where the government can step in is directly impacting individuals, via, unemployment benefits or, in this instance, direct payments. So, so there are certain areas where monetary policy, might not be able to do everything itself. And that's where the government can step in. And that's what we've seen. So all this action has been at the federal level. You have seen on the margins some things done at the state level. In New Jersey, for instance, Governor Murphy had partnered with some banks on, mortgage forbearance or 90-day mortgage forbearance and kind of no questions asked forbearance. But in terms of actual direct impacts, all of that's been done at the federal level, largely because, states, as many are well aware, are getting hit extremely hard with businesses closed. Tax receipts are down quite a bit. Costs associated with the pandemic have gone up quite a bit. So I think at the state and local government level have been struggling and likely will continue to be under some pressure for some time. So pretty much all that we've seen from the fiscal side has been at the federal level. If we can move to the next slide. So as everyone I'm sure is aware by now, the CARES Act was the biggest piece of the fiscal policy. In total, it was about $2.2 trillion, which to put in perspective is a little bit north of 10% of GDP. Certainly is an unprecedented a fiscal policy action, but was likely needed. A lot of what happened was, because of the pandemic, a lot of businesses were forced to close, and the federal government, kind of had to step in because of the nature of the pandemic and how it was affecting people. So, there were, many different areas that the Fed used. The $1,200 stimulus checks were obviously a big piece of it. Enhanced unemployment benefits, that was in the form of an extra $600 a week going to those who were unemployed. The Paycheck Protection Program initially was, I believe, a $600 billion small business loans given to businesses who were facing significant financial stress because of business closures. And, a handful of other things. I noted the eviction moratorium on renters. There was also pandemic unemployment assistance, and that was essentially an extension of enhanced unemployment benefits that was focused on gig workers, right? So, the economy has certainly changed quite a bit over the course of, the past 10, 20 years with the growth of, kind of new businesses, e-commerce, the internet. So gig workers were also very impacted, the Uber drivers, the Lyft drivers, artists, as well as people, simply affected by the pandemic. So this would impact people who had excess childcare responsibilities because kids were no longer going to school, or people who were planning on working who may not have worked because of the pandemic. So the federal government decided, instead of having the, kind of stricter unemployment benefits only for those who are out of work, they were also going to help people who may have worked otherwise, but decided not to. So, as I said, this is kind of an unprecedented response from the government, but something that was likely necessary, given the state of the world. So this kind of, chart really just visualizes the CARES Act in focus. You can see beginning in April, this was right when the CARES Act went into focus. You have the three biggest buckets here: the enhanced unemployment benefits, you have the PPP loans going out to businesses, as well as stimulus checks going to homes. And you can kind of see the staggered nature. As the government had to continuously step in. I think we know that the PPP loans, for instance, those ran out, I believe, in the first a week of that being announced. So the government stepped in and enhanced that program and offered more loans to families. So as we move forward, you can kind of see, I mean, the amount of monthly federal outlays has pretty much doubled, in certain months over the course of the pandemic. I think, we're likely to see this come down in coming months. As I'll note in a couple of slides going forward, the go forward stimulus is a bit uncertain, but it's seemingly, the $600 a month unemployment benefits have run out. They have been replaced in the short term by direct action from the government, but we're likely to see those federal outlays begin to move back down to that 2019 range on a go forward basis. So have the fiscal policy actions helped? I think, definitively yes. There have been a number of academic studies that have looked at, how the government actions have impacted people. We can see that the money did go out very quickly, income increase, and that supported spending. There were a couple of studies published actually that said the marginal propensity to consume was anywhere from 25 to 50% on average, and 45 to 70% among lower income consumers. And surveys actually also indicated consumers spent about 40%, of that money that came in from that $1,200 stimulus check, saved about 30%, and 30% went down to paying down debt. So it's pretty clear that these actions, had a pretty clear impact. From my world, I cover the freight sector, and we saw FedEx just reported earnings. They noted that ground volumes are up 30% because of the growth in e-commerce. So clearly a lot of this money has been flowing into the economy and really helped at a time when, otherwise things did seem quite dire. So as I had mentioned on the previous slide, we are seeing a reduction in payments, and that likely will have an impact. Goldman, for example, we just lowered our fourth quarter GDP forecast to 3% from 6%. Previously, we did believe you might have some stimulus entering the market via a second stimulus bill. And as we move, closer to the election, it seems like that is growing more unlikely. So certainly, the reduction in payments likely will have some impact. So here's a great chart to, visualize just how much the fiscal actions, did support income. So you see disposable income jumped pretty much immediately. That's kind of right in line. You can see that started in the April-May timeframe. That's right as the payments were going out to homes, when the unemployment insurance was going out to homes. And you see that the kind of reverse happened with PCE, right? It dropped, kind of fell off a cliff right in April. But then as that money came in and started flowing through into the economy, you saw PCE start to tick back up quite a bit. And again, you can see from the market examples, there are clear examples of where this money was benefiting. If you look at, Wayfair, Amazon, really anything e-commerce related has seen significant benefits over the course of the past 6 months or so, right? In talking to FedEx, actually, again, they just reported earnings, and they've said it's been, kind of Christmas in March, and they reference Christmas because that's their peak season where their package volumes kind of double on a daily basis. And they've been dealing with that, basically since March. So, I think that, not all of it is directly a result of the fiscal actions that the government took, but, it certainly helped quite a bit, and has really helped, both on a personal, individual basis, as well as a lot of the companies that would have otherwise been struggling. So, like monetary policy, fiscal policy, can't solve for anything, or for everything, sorry. Fast deployment of funds is critical, but, I don't think that any of us would argue that the government is generally the best at getting things done extremely quickly. However, in this instance, they were actually able to get money into people's hands fairly quickly. The downside, of course, is that if you do move funds out quickly, there are a number of inefficiencies. There have been, some examples with the Paycheck Protection Program, people, using that money for fraudulent purposes or doing things that are not, that were not in the hopes of the money going out. But again, because of the nature of, of the downturn in the pandemic, it was deemed, better to get money in people's hands quickly rather than having to wait. Because again, if you move funds out too slowly, there's a lot of increased or decreased effectiveness. A lot of restaurants obviously were struggling quite a bit, but still had to pay rent, still had a lot of overhead costs they had to maintain. So getting money out was extremely important. And finally, obviously, with how our government is structured, there's a lot of political bargaining that goes on, which we've seen a lot with the most recent round of stimulus talks, and oftentimes can create inefficiencies or ineffective policy measures. So one of the biggest kind of risks we have going forward, obviously, as a result of the pandemic, the government spending has increased quite a bit. I talked about the 2.2 trillion from the CARES Act, 10% of our 2019 GDP levels. And that largely resulted in an increase in debt. To debt levels we really haven't seen since the 1940s or 1950s. You go back to the previous recession in 08, 09. We certainly did see a pickup in debt following that level, but on a debt to GDP basis, that was still only in the kind of 70-75% range. So right now we're sitting at around 104%. That's an estimated level, and looking on a go forward basis, that level is likely going to increase, right? I think there's a lot of talk about the election. I think on both sides you will have policy measures aimed at continued stimulus, whether that's on an individual level, whether that's on an infrastructure level, because the economy, it is still rather weak. A lot of estimates out there say 2020 GDP is going to drop by around 3.5%, 4%. So, you still have a lot of weakness in the market. So, I think the government will still likely try to do more stimulus, and the downside, of course, to that is increasing our debt levels. So where do we go from here? Jerome Powell said, the path forward for the economy is extraordinarily uncertain and will depend in a large part on our success in containing the virus. Uncertainty has really been something that we've heard from everyone. Almost all companies that I cover have taken away their guidance because they just don't know what's going to happen, right? Almost everything is dependent on, the curve of the virus, and that's just something we don't really know. We do have a lot of vaccines in the works, and to the extent that is helpful, we may get some more certainty. But as of right now, because of the nature of the pandemic, things are just extremely uncertain. The third quarter GDP growth, should be up quite a bit. A lot of estimates are in the 32% range. I think our economists at Goldman are looking for a 35% increase. But again, you may see employment growth slow. As a lot of the reopening effects have already taken place. Fiscal actions are starting to fade. As I've touched on a couple of times, we don't have more stimulus coming in to take place of the stimulus, that has rolled off. So to that extent, we may see some of that growth slow. You've seen unemployment claims largely kind of level off. I think we'd hope that number would continue to come down. But because the large brunt of the reopenings have already happened, I think you're starting to see that number stay a bit stickier. And again, when uncertainty is elevated, that reduces spending, and that's at both an individual level and a corporate level. You know, companies, one of the biggest things they need is a clear picture before they spend. So I think you're going to see a lot more reserved, you know, capex coming from companies, and you may see individuals move more towards savings rather than spending on a go-forward basis because uncertainty again remains high. And, you know, last but certainly not least, there's going to be a lot of long-term structural changes which may slow the recovery. I think one of the biggest ones is going to be work from home, right? So, you know, everyone has kind of adapted to the work from home lifestyle. But, you know, I think, you know, you may see that have ancillary effects on the economy, right? You know, looking at, you know, New York City, I think is at about 10% attendance for the broader office population, right? So that has a lot of knock-on effects, right? So the service industry is going to be impacted, and that's something that's going to take some time to, you know, get back to normal, right? So, you know, what we're seeing is a lot of places may not go back to full employment on an in-person basis till mid next year, right? So those longer-term structural impacts are likely to impact the overall economy, and, you know, may stretch out that recovery quite a bit longer than initially thought.
Thank you, three. All right, well, it's now time to ask all of your questions. I know we had one yesterday, so I'll reference that first, but if you have a question for our panel, please put it into the Q&A box and we will ask their professional opinion. But I will start with a question that was asked yesterday. We had a session with our political science professor and our CNN reporter about how the election might impact the economy. You all alluded to it, but if you could speak a little bit further about that, that'd be great.
All of us are waiting for the other to jump in.
Right.
Yeah, sure. So I can start a little bit. You know, so the election is certainly highly uncertain at this point. I think, you know, polling averages are kind of, you know, mixed across the board. But I think one thing that we've seen, and at Goldman we put out a bunch of research around this, is both presidents are likely to spend going forward, right? So whether that is President Trump on an infrastructure plan or something along those lines, I think what we're generally seeing is that spending is more likely because I think the overall economy is still depressed, and I think both presidents, you know, obviously, you know, the economy is generally something that is one of the biggest factors in most people's lives on a day-to-day basis. So I know a lot of focus has been around Biden and the tax policy, but I think one of the bigger things is that there is likely spending to offset the potential impacts of a tax increase, right? So not to get political in any way, but those are the policies out there. So, you know, what we're generally seeing is that both presidents are likely to spend in some way, which theoretically should be stimulative for the economy and for GDP overall.
Any additional thoughts, Dave or Laura?
No, that was a great answer.
Okay, good job, Nick.
Too much uncertainty otherwise to add anything to what he has said.
Perfect. All right, we do have a question from a current parent who is thanking you first and foremost for being so interesting, more interesting than any econ class that they took in college. But besides summarizing the impacts like this, how is Bentley, and perhaps this is more a question for Dave and Laura, incorporating current events into curriculum to enhance our students' understanding of what's happening right now with economic policy?
Well, I'm sure I'm speaking for effectively every economics, finance, and other professor who's teaching a class in this right now is sometimes we're altering our lectures and our class material on a day-by-day, week-by-week basis, you know, based on current events. You know, for example, back in March, when we all had to abandon the campus and move toward, you know, a full Zoom infrastructure, I ended up throwing out, you know, standard lectures on what monetary policy is doing, and I had to redo everything because the Fed effectively reinvented the policy playbook. And so I was making up lectures on the fly, and then I would deliver these to my students, and then the Fed would do something else the next day, and then I had to change my lectures again the following day. So I'm sure that all of us, you know, we're all desperately trying to keep up with what the Fed and what what the general policy response is. So we're working very hard to incorporate current events.
Yeah, no, I agree. I was teaching the same class that Dave was teaching in the spring, so it was very much kind of wake up in the morning and figure out what you needed to teach that day if something had changed dramatically. And so the class in particular that he's talking about, it is an advanced level course where you're really digging into monetary policy on a daily basis. But so I'm teaching principles, so kind of the other end of the spectrum right now. And I mean, we can just simple thinking of things like supply and demand, where are people spending? And so we're doing stuff like looking at the market for, restaurant meals, or the market for gasoline or public transportation, just stuff that's going to fundamentally, the whole structure of those markets will be changed, at least going forward for a little while, if not more permanently. So it's, kind of on a more, intro level, we're still able to use these things on a regular basis.
Thank you. And I know here in Massachusetts, there is a really strong lobby to help save the restaurant industry. Do you think there will be federal level policies for specific industries, whether that happens after our president is elected or re-elected, whatever the case may be?
It's possible, but given the constraints that the federal government and also state and local government is going to face, that's going to be a very difficult road to go across. The level of spending, the level of debt, as Nick noted in his part of the presentation, are now off the charts. And so if a particular industry like restaurants, like the airlines and so forth, they got support, and that's scheduled to expire within the next month or so, and they're looking at laying off tens of thousands of people. The idea being, of course, that currently in the pandemic right now, the demand for air travel has cratered, and even once things return kind of at least sort of to normal, there could be dramatically lower business travel, for example, and a giant chunk of the leisure industry depends on business travelers, airlines, hotels, restaurants, and so forth, and there simply aren't enough resources to support all of those industries, especially if there's a permanent decline in demand. And so what happens is, in a dynamic market economy, is resources are directed away from industries where demand is declining and toward industries where it's increasing. So it's going to be very difficult to support long-term particular industries going forward. Short-term, they've been able to do it, but this is not sustainable long-term.
Thank you. All right, and I know we're speaking very specifically about the US, but are there other trends and things you're seeing in the international economies that perhaps are impacting the US, or things to consider for the US going forward?
Yeah, in Europe right now, there's, especially in Spain and France, for example, they're seeing a pretty dramatic uptick in the coronavirus. And to the extent that that has a negative impact on those economies, then that's going to blow back on the U.S. in terms of lower exports, lower trade, and so that will, not derail the U.S. recovery, but at least, certainly, slow it down. We are seeing a reasonably solid improvement in economic activity in the Chinese economy, which of course helps us. But other parts of the world are still struggling. South America is struggling. Brazil, for example, India, and lots of other of our major trading partners are still having their own serious problems of varying degrees, and that in turn restricts our ability to recover, unfortunately.
I think we're also having a bit of like a first mover disadvantage of some of these countries that are reopening, and so kind of I think we were able to observe what happens as some of them are starting to reopen their economies, and are people actually getting back out there and spending, because one of the things we mentioned is, right, like our policies can only be effective if we can encourage households to actually go spend, all right, get people out of their house. And so we're kind of like watching how some of this stuff plays out in some of these other economies, and maybe taking a step back to realize, when and at what pace should we be reopening everything.
The last piece I would say actually is the supply chain is still suffering a bit. So one thing that we noted, right away actually is A lot of people don't realize, but 40% of capacity out of China flies in the belly of passenger airlines. 60% of freight capacity flies in the belly, out of Europe flies in the belly of passenger airlines. It's a pretty substantial amount. And because, as Dave noted, the airline industry is being significantly hurt, capacity is still significantly constrained. Back in April or May, John Deere set aside $22 million for excess freight costs. Because instead of putting something on a passenger airline, you had to go to a freight company or a cargo company, and they were able to essentially charge surge pricing because they didn't have any space available. So to the extent that international travel is still depressed, that actually does have knock-on effects for the supply chain in the U.S. And especially initially, out of China, we imports fell off a cliff, right? Because a lot of the cargo freight liners, or the ocean liners, weren't leaving China, had to go via airlines as well. So there was a really significant capacity constraint, and we haven't really seen that alleviated, and likely won't. I mean, you can't really build planes very quickly, right? So FedEx, UPS, a lot of the dedicated cargo capacity operators are working as hard as they can, but until the passenger airlines come back, you're going to see supply chain constraints in the markets.
Thank you. We'll take one final question. And someone's asking if it seemed like the US's short-term solution was to print more money. Should we expect that to lower the value of the US dollar in the near or medium future, leading to an economic downturn on the horizon?
I can start this one. So while if we think of like the immediate impact, you typically would say printing more money could lower the value, but really a lot of the value on international markets of US currency is driven a lot by demand for holding assets in dollars. And so while our economic conditions, yes, are still rocky and our recovery is uncertain, US assets are still quite safe. In particular, US treasuries are still quite safe. And so there's still sufficient demand. And so we're actually seeing that, a lot of kind of like safe haven investors choosing to hold the dollar instead, not really threatening, I think, too much of a weakening in the currency.
Yeah. If I could also add that early in the pandemic, one of the Fed's initial responses was to open what they called a dollar swap line. And the reason they did this is because the worldwide demand for dollars skyrocketed as a safe haven. And the dollar is an important world currency. And since dollars were very high demand, the Fed effectively lent dollars to other central banks. Now they've drawn that down as financial markets have calmed down somewhat, but the initial response is that the dollar rose. Since then, the dollar's fallen somewhat, but it certainly hasn't been dramatic, partly because other central banks have also pursued very expansionary monetary policies. Ordinarily, when a central bank alone pursues an expansionary policy, that does tend to depreciate the currencies. But if all central banks tend to do it at more or less the same time, then that sort of limits some of the downside, at least in terms of the US dollar. And plus, the US dollar still remains, the world's most important reserve currency. As Laura said, there's a huge demand for dollar-denominated assets. So that does, I think, put a real downward limit on the dollar's decline in terms of other currencies.
This was great. Thank you all for dedicating some time on a Saturday morning to talk about these important issues with us. As we did with your session earlier, Dave, in the spring, can you leave us on a positive note? What might be a silver lining of our current and sort of former situation?
Well, I think the silver lining is that necessity is kind of the mother of invention here. And even though we're still in the midst of a pandemic, the economy's recovered somewhat, but we still have a long way to go. There are material signs of optimism. One of the things that I think is most optimistic is that the number of new business starts in the last few months has risen dramatically. Now, again, to some of that's necessity. This is done by people who've lost jobs, but in a dynamic market environment, a situation like this provides a lot of challenges, of course, but it also provides a lot of opportunity. And entrepreneurial, adventurous people in droves are taking advantage of these opportunities. And so you have the starts of whole new businesses and whole new industries that otherwise would not have been given the opportunity.
Anything to add, Laura or Nick?
I think that was a great answer. That's
Yeah.
a very nice shining spot to look at. And I'm kind of every day impressed at the speed at which we're learning to react to stuff right now, both in terms of businesses or policy or research. It's just everything's happening, like he said, out of necessity, but it's, you know, the future implications for what kind of investment we're doing right now will be really important.
Well, thank you three again
Very
for
welcome.
giving us your time. We appreciate it, and we hope everyone enjoys the rest of their Falcon weekend.